How can investors who are say investing in a debt mutual fund, how can they lock higher yields?
With the rally which has happened in gold prices and silver prices, I kind of find both gold and silver expensive at this point of time.
How can a retail investor invest like an expert?
Any asset classes which is at the peak, you'll only see good news.
How do you do your portfolio allocation? Like, how is your portfolio split across the different asset classes?
I made investments in China, equities, 2 years, 3 years back. Recently, I have made allocation to Brazil.
How do you see the next 5-7 years for the debt market? Hey everybody, welcome to the Alt Investor Podcast. I'm your host Ankur, and today we're going to be talking about debt mutual funds. Our guest for the show today is Manish Banthia, who's the Chief Investment Officer of Fixed Income at ICICI Prudential AMC. So thanks a lot, Manish, for coming here. I am personally pretty excited to understand more about the debt space in India today. So let's address the elephant in the room. The Sensex has given close to 0% in the last 1 year. But there are debt mutual funds which have given 8, 10 or even close to 12% returns. In spite of that, the Indian investor is not very excited about debt mutual funds. So one is I would want to understand why that's the case, and two, what should an ideal investor's portfolio look like when you include debt in it?
Right. So thanks, Ankur, for this conversation, and happy to answer questions on fixed income. Every asset class has a economic cycle behind it, and it is important to understand it. There are times when investors like a particular asset class, and the reason behind that is largely the experience which investors have had in that asset class. So for example, back in 2014 to 2020, a lot of money used to come to fixed income. And the reason was that at that point of time the economy was slow. If you look at corporate earnings were in very bad shape at that point of time, and therefore given that RBI wanted to support the economy, there were rate cuts which were being done. Liquidity was generally supportive at that point of time. So debt funds saw a lot of inflows because the other asset classes were not performing. After 2020, what we have seen is that there's been a cyclical recovery in the economy. And cyclical recovery in the economy means that, corporate earnings have largely done well, but for the last, few quarters, and which has reflected in, better asset performance as far as equity is concerned. And which is why in the last, 4-5 years, we've seen that there's been outsized return on equity as an asset class. And which is the reason why investors have moved, and investors generally are a little late in terms of moving. So we've seen that larger flows have started to come in post 22 and 23, and investors, because of past returns, have kind of seen equity as a good asset class. The experience has been good, and which is why equity is a flavor at this point of time. The other thing which has happened is in March 2023, the taxation on fixed income, that changed, and that made equity relatively more favorable, largely for people who, are taxed at the maximum bracket. And, which is a reason, again, whatever satellite allocation used to go to fixed income, that has moved, to equity. But that doesn't mean that, over cycles, the asset allocation pattern would change.
Okay. So now with the market, the way it is, do you think it's time for fixed income and debt to come into the picture again with the retail investor?
I think there's still some time. I still see that, whatever has happened in the last 1 year, while last 1 year has been a period where economy was slow, but I think from here economy will again start to gain momentum. Given RBI has cut rates, government has done GST cuts, direct tax benefits have come to individuals. So all of that, if you add that up, would mean that economy would recover and earnings will catch up again. So I think the next few quarters again, you will see that corporate earnings will improve. But I think that is where at some point the cycle will peak. We have had this economic cycle which started in 2020 and we'll be completing almost 5 years. I don't see that cycle has ended at present, but at some point of time in the next 1.5 years, you would see that the cycle could start to look peakish, and which is where I think it could happen that we'll have some excesses in the economy, and at that point of time the asset switch will become important. So while in the very next few quarters, I think corporate earnings and other things would improve, which will favor maybe equity over debt. But from a long cycle perspective, I think debt cycle is not very far off.
Okay. So since you mentioned RBI rate cuts also, now whenever RBI cuts the rates, we see the fixed income earnings also are lesser. So in an environment where the rates are lower, how can investors who are say investing in a debt mutual fund, how can they lock higher yields?
So we run there are different products which are available to investors, right? There are products which concentrate on long duration, which are favorable when RBI is cutting rates and yields are coming down, because there you make capital gains out of investing in such products. And at times when there are no rate cuts or rates are being hiked, you have short duration products which have reasonable carry, and where as the yields go up, your carry in the portfolio increases, and therefore the prospective return for investors also go up. So one can switch between these two kind of products given where you are in the rate cycle. And given that people can't perfectly do it, there are other products which are dynamic duration products that can do it efficiently for the investors. So we have one such product called all season bond fund, where we use different strategies between government securities, between AAA, AA corporate bonds. And the idea is that we keep switching from asset classes, we keep switching duration to make sure that wherever you are in the interest rate cycle, the portfolio is placed accordingly for you. So you need not switch portfolios, the portfolio will do that for you.
Okay. And what fund is that you said?
It's all season bond fund.
All season bond fund. Okay. So today if I were to look at the environment right now, is it a good time to do a lump sum investment in a debt mutual fund, or should I start or continue my SIPs? And if lump sum, then what kind of mutual fund should I go for today?
So I think you should do a portfolio allocation in fixed income at all points of time. And to me, a easy strategy for that is to stay invested in a fund which can and it's not that cyclically I would say that debt is a very good asset class today to invest, but from an asset allocation perspective, I would prefer fixed income to be there as a part of the portfolio allocation. And to me, the dynamic asset allocation strategy to me looks good at this point of time. And it can be done at any point of time lump sum. I don't need in that product to time the market. As I said, the product itself changes its overall architecture, and therefore it's a suitable product to be invested for a very long period of time. And one good thing about mutual fund is that the incidence on taxation, right, that doesn't come unless you come out of the product. Effectively meaning that unless you sell, right, and exit, the tax incidence you can defer it. So if you do a portfolio allocation and stay invested for a long period of time, say if I am 46 years right now, and I know that I'll work for another 10 to 12 years, 14 years, and after that retirement would hit me at some point of time, I can defer my taxation by staying invested in a particular product, and then I can divest at a particular point of time when my normal earnings are low, and therefore my incidence of tax reduces there.
Okay.
So rather than churning products, I would want to select a product where I can stay for a longer period of time.
Okay. So one thing that I'm always curious to kind of understand from fund managers is, how do you do your portfolio allocation? Like, how is your portfolio split across the different asset classes?
So I'm quite dynamic in my own portfolio allocation. I have always used my own portfolio allocation as a strategy to understand new asset classes as well. For example, I started investing in gold back in 2015-16 personally, and that helped me to create a framework in my mind in terms of how to look at gold as an asset class. Similarly, I've started to invest offshore in the last 4 to 5 years, and that has helped me to understand global asset classes. So I'm kind of dynamic from that perspective. As far as the current allocation goes, fixed income is around 30% of my portfolio, and I think that is the minimum I would want to keep, because that gives a lot of stability and safety to the entire portfolio. Apart from that, I am invested in global assets. I made investments in China equities, 2 years, 3 years back. I reduced my Indian equities at that point of time.
And these are direct equity or via mutual funds?
Via ETFs.
Okay.
Via ETFs.
Okay.
Recently, I have made allocation to Brazil. That I think from a global asset allocation product, China was at the bottom of the cycle, and it looked that at the bottom of the cycle, and the asset class was very cheap. The dividend yield in that asset class in certain spaces had gone up to as high as 6%, 8%, 10% as well. So looked very attractive in a country where interest rates are 1% and your dividend yield on assets are 6%, 8%. Looked very appealing at that point of time. I think Brazil is that same situation today, where dividend yield is high, assets is just too cheap at this point of time. So that's the global part. On the Indian part, I'm kind of positive on the economic recovery. So in the past some time I have increased my allocation to Indian equities as well. I think my expectation is that with economic recovery there will be a rebound in equity markets in India as well. While valuations may look expensive, but I think the cyclical rebound in the economy should reflect in equity assets as well. But as I said, asset allocation is the key for me. So I keep on allocating assets depending on how relative value has changed. And the other is, I was very bullish on gold and silver in my personal portfolio as well. Right now, I think both gold and silver have performed very well. So I find both the asset classes expensive now. So to me, it's a time to switch out of these asset classes and get into some of the other asset classes which are cheap.
Okay. That was actually going to be my next question. Is it a good time to invest in gold and silver now?
I think, look, the way I have, positioned gold in my portfolio, part of it is out of, again, safety. Gold, is a neutral asset class from a global asset allocation perspective, and therefore one should keep some allocation in gold, but doesn't mean that it has to be very high. I mean, 2 years, 3 years back, the allocation could have been much higher, given that gold was very cheap again, against Indian equities, against, the US equities. But now, with the rally which has happened in gold prices and silver prices, I kind of find both gold and silver expensive at this point of time. So there's a clear switch which one can do out of gold and silver. And my style is more value oriented, right? So I would want to get into asset classes where I find value, and move out of asset classes where the value is already, come out. So gold and silver to me right now are momentum asset classes. It's very difficult to define, why they are valued at the price at which they are valued. There's a narrative which is flowing in both these assets, but that narrative is, not proportionate to valuation of both these assets. So these valuations are much higher than the current narrative, and which is why I'll be a little more skeptical about both these assets today.
Okay. So there are a lot of things that retail investors have to consider, right? Like how you mentioned now that gold and silver valuations are high, but the narrative that's going on is that there's global uncertainty, central banks are buying, so it's still going to keep increasing. So how can a retail investor invest like an expert? Like, what are some of the strategies that say an institutional investor or an HNI uses that a retail investor can also replicate, so that they are not buying gold when it is the most expensive, for that matter?
So one analogy I'll give, any asset classes which is at the peak, you'll only see good news. And the reason why you'll only see good news is that because it is in the phase of that cycle, the prices are high because there's good news, right? So it's not that whatever you are hearing is not discounted in the price. So while the narrative for gold and silver, as I said, is very positive today, the prices have also moved in line, right? And therefore it is reflected in its valuations as well. Similarly, when the asset class is out of favor, you will not hear people talking about it. That is the best time to accumulate those assets. I mean, it's not easy for retail people because I understand that they're not too much into financial assets. So therefore to approach some of these is asset allocation products. And at ICICI Mutual Fund, we've concentrated a lot in asset allocation strategies. We have a number of products which does asset allocation between different asset classes. And our idea is that assets which are reasonably valued should find more weightage in the portfolio, and assets which are expensive should have reduced weightage. And if you do that kind of asset allocation, naturally you will have more allocation to some of these assets. So for example, as I said 2 years back, we were very bullish on gold and silver. We started marketing multi-asset fund at that point of time, right? And if somebody who would have invested in multi-asset fund would have directly got exposure to both gold and silver through multi-asset fund. Similarly, some of the other asset allocator product that we run, we have asset allocation fund, we run balance advantage fund. Some of these strategies does this asset allocation for you. So I think if I was a retail investor, I would not put too much of my mind because I'm not an expert. I would leave it to the experts, and the asset allocation product to me is an expert who does allocation within a certain framework. I would believe in that, and I would put my money in asset allocation products.
So I think your marketing worked well, because I personally also had invested in ICICI mutual fund only, and I mean it's done well, touch wood. So that way it was good. But having said that, even for a mutual fund, for a retail investor, it becomes a little challenging to understand, right? Ki which mutual fund should I invest in? Which even within a mutual fund, what parameters should I look at? So what should a typical retail investor look at while selecting a mutual fund?
So one, the fund house selection is important, right? And when I say a fund house selection, you have to look at a long history of what the fund house is about, what its philosophy is, and there you have to do some research. That culture and philosophy is something which stays with the organization for a long period of time. There will be cycles. Some fund houses will do well in a particular cycle, other fund houses will do well in some other cycles. But from a very long-term perspective, if you have a framework, if you have a culture around the way you manage things, I think the long-term output will be very good. So to select a fund house, you have to look at the long-term performance of the funds, not the short-term performance. Whether it is fixed income or whether it is equity, doesn't matter. Look at a 10-year performance, look at a 15-year performance. And now that mutual funds are there for more than 20-25 years and they have managed fund in size, long-term performance is available to all investors. So don't look at a 1-year performance, don't look at a 2-year performance, at least look at a 5-year performance and then judge. And I think 5-year is also a small horizon. If you're investing for 10 years in a fund, then you have to look at a 10-year performance, 15-year performance, and then judge how a particular fund house is doing.
But doesn't that also change, like mutual fund rankings also for that matter? Today, if a particular mutual fund is, say, ranked 1 or 2 or whatever, say 5-7 years later, it won't be at number 1 or number 2. So in that case, then what should investors consider before they invest? Like, say if I were to look at 3 things apart from the ranking that my platform is giving me. Apart from that, if I were to look at 3 things as a retail investor, what should I see?
So one, your rankings on the 1 year, 2 year will keep shifting. Up to 3 years will keep shifting. Your ranking on 10 year will not shift. You can look at the past data as well, right?
Okay.
Because as I said, there are cycles where one fund house will do well compared to the other fund house because the styles are different. But these styles over 10-year period, each fund house would have its own time in terms of style. So if you look at a 10-year performance, that shift will not be, very large. So which is why I'm saying that if you look at a 10-year performance, that is a much better strategy if you want to invest in a fund and stay there for 10 years.
Okay.
Apart from that, I think, as I said, the culture is very important. The culture is also reflected in terms of, what the fund does, and, if, invested for a long period of time, or you can talk to, the intermediaries, who or advisors as well. They will help you understand, culture of each fund house, and each fund house has a different culture. I'm not saying anything is good or bad, but the cultures are different, and therefore, that culture has to suit your, expectations as well. So that is the second part. First is, you can't ignore the long-term performance. The second is the culture, and thirdly, the communication. That I think is very important. It's very easy that, today I can talk good things about gold and silver, right? But would that help you? I mean, when there's momentum, there's already bullishness. The prices have doubled in the last 2 years, 3 years. So therefore, communication is very important. If I'm communicating for next 1 month or 2 months or 3 months, and I'm telling you invest for 10 years, I mean, there's some, issue in terms of what I'm trying to tell you. So effectively, the communication also has to be in line in terms of what you are recommending to investors. If you're recommending long-term investments, then you have to, recommend assets in terms of your communication, what is good for the next 5 years or 10 years. It is always easy to catch eyeballs, talking about, what is good at that point of time. But what is out of favor, what will make you money in the next 5 years, if you're communicating in that way, I think that is something which you should look at. So these 3 things are important.
Okay, understood. Now, I've been hearing about these income and arbitrage funds. I've been hearing a lot, but what exactly does it do? It seems to be an interesting concept, but what exactly do these funds do?
So, after the change in taxation, investing in debt, as I said, if you're a marginal taxpayer, you have to pay marginal tax on the debt investments which you do. Now, this category of funds, income plus arbitrage, 40% of the, investment, it's a fund of funds, so invests in a different category of funds. 40% of that is arbitrage funds, and 60% of that is debt funds.
Okay.
And by doing that, you stay invested for 2 years, you will be taxed at 12.5% plus cess and surcharge. So effectively, you reduce your incidence of taxation by, adopting that strategy.
Oh.
So it's like a very attractive way to invest in fixed income, because any which ways, we don't invest for 6 months normally, right? Our investment horizon is more than 2 years, and therefore, if you choose this strategy, your overall tax post-tax returns, improve in terms of tax efficiency.
So they have, you said, 40% in equity.
So 40% is in arbitrage funds, and arbitrage fund returns are more like debt returns, right? And the remaining 60% is invested in debt products.
Okay.
And there we select products depending on what suits a particular cycle.
Okay.
So again, that is dynamically managed.
But the taxation is that of equity.
So yeah, 12.5% for 2 years, not 1 year.
Okay.
So it's an interesting product. These products, have been introduced in the market in the last 3 to 6 months, and I think these products will gain traction. So I think it's one of the good ways for people who are, taxed at the highest bracket to come into the fixed income markets through some of these strategies.
And what range of returns would they give roughly?
So, look, typically, to me, the fixed income returns have been in the range of 6 to 10%. That's a broad range, depending on which part of the cycle you invest in. So, my expectation, from a longish perspective, remains in that range.
Okay. And so, income plus arbitrage funds, what investment horizon are they recommended for?
So, at least 2 years, because if you don't invest for 2 years, then the tax advantage doesn't come in. But I think, again, as I said, the horizon for investment has to be long as far as fixed income is concerned. You have to look at fixed income from an asset allocation perspective. So just to connect to your first question, how much allocation, should one keep in fixed income? The way I look at it is that, between different asset classes, there are times when you require safety of the portfolio. while, as I said, equity as an asset classes has given very good returns over the last 3 to 5 years, there can be a period of time, and we've seen this across the globe, right, where equity for certain period of time has underperformed, may have given negative returns. At that point of time, if you need safety of your overall portfolio, you need certain constant accrual in terms of returns in your portfolio, you need fixed income. And which is why asset allocation is so very important. Think about it, that if I'm 100% invested in one asset class, and there have been periods of time that for 5 years, 10 years, those assets have not delivered any reasonable return. I mean, in that case, your overall portfolio returns will look very bad. But if you use asset allocation as a strategy, then you hedge your risks appropriately. And I think for retail investors, it is appropriate that they think about investing from an asset allocation perspective. X percentage in debt, X percentage in equity, and X percentage in, say, some other assets, maybe real estate, maybe commodities, whatever they think is reasonable. But they have to think about asset allocation when they invest.
Okay. One question, since you spoke about stability, there is a misconception that people have that all debt funds are safe, and it's not always the case, right? So what are some of the risks that investors should be aware of when looking at fixed income or when looking at debt funds?
So typically there are two risks in any fixed income product. One is a credit risk, and the second is a duration risk, which is an interest rate risk. Credit risk effectively means that if you're investing in a portfolio which has assets which can go bad in terms of the issuer or the bond in which you are invested is not able to repay back, right? Then that part of debt kind of goes bad, and therefore your return gets impacted out of it. So for example, if I invest in a portfolio which is low grade portfolio, then I have to be aware of the fact that a low grade portfolio can slip. In terms of probability of slipping is higher, because the credit risk inherent there is relatively higher. So that is the first risk which people will have to keep in mind. The second is the interest rate risk. Now, interest rate risk, these are cyclical risks. It matters in the short period, but over long period it doesn't matter as much. For example, globally we've seen that interest rates were very low. I mean, we've heard that so many bonds were trading lower than 0% before 2020. And in the last 4 to 5 years, we've seen that yields have gone up. So some of these very high duration products which invest in 30-year bond, 40-year bond, they have given negative returns as high as 20%, 25% in US. So effectively that is one part of the risk which one should be aware of. But as I said, these are more cyclical risk. It doesn't completely erode your portfolio, but on the timeline it will reduce your growth or return potential.
So largely I think credit risk is one factor that investors should look at, and probably see what are the ratings of the underlying assets in which the mutual fund is investing.
Right. So rating, of course does matter. But I think the way I have looked at it, largely I think the space in which mutual fund operates, and which is largely AAA, AA, there's some amount of single A as well, is not a very risky space. So I kind of see that from that perspective, as far as the mutual fund industry is concerned, credit risk is not a very skewed variable.
We did have the Franklin Templeton saga though, where a lot of investors lost money, right? So, I mean, I would want to ask whether it is actually possible to lose that kind of money, or are there better regulations now that will make sure that this kind of episode doesn't happen again?
So. Again, that was a singled out episode. In the last 20 years I have been in this industry. So one one thing which happened in 20 years should not be seen as something which you can paint the entire industry. Secondly, I think each fund house, as I said, you'll have to understand the philosophy culture of each fund house, and I have seen that largely mutual funds have done very well in terms of risk management. Thirdly, as a regulator, we've seen that regulations have tightened over the last so many years in terms of how the mutual funds approach markets. So I think that is the other overarching way in which risks have been managed. So I think that was a singled out episode, and that should not be seen as a base, and then you kind of invest looking at that as a base case scenario.
Yeah, which is why I wanted to ask you this, because a lot of people still say that people have lost so much money, and you're right that it happened once in 20 years, so it shouldn't be a benchmark for anything. So Manish, one last thing that I want to understand, the equity markets have seen a bull run in the last 5-7 years, and India, I think, has started, a large part of India has started investing in equity in the last 5-7 years itself, right? How do you see the next 5-7 years for the debt market or for the fixed income market?
As I said, in the short term, I am hopeful of the economic recovery, and therefore equity as an asset class should reflect that economic recovery. But I think from a more medium term angle, I think debt will come back. I think people who have overly invested in equity should start to think about asset allocation and start to look at debt as a asset to kind of get stability to the portfolio. Because as I said, ultimately they all link to economic cycles, and the cycles change. You normally have cycles which last for 6 to 7 years, and then the cycles change, because normally at the start of the cycle everything is good. As you reach the maturity of the cycle, excesses get created in every cycle, and once the excesses get created, after that the cycle takes a long time to repair again. And which is where at that point of time, if you're invested in an asset which already has kind of discounted everything which was good in that cycle, then the returns later would be suboptimal. So from a medium term perspective, I think tax change or whatever, I think some people think that after tax change you can't invest in fixed income. I think ultimately the prices reflect everything. So equity having now gone up in valuation is already reflecting the change in taxation. So if just to keep things simple, if say my overall expectation on equity return is 12%, and if valuations have kind of changed now, right, that 12% expectation has to come down to 10%. Right. Yeah. While in the near term it will look that things will be very good, but long term what you're saying is you are discounting a lot out of future into what you have today. Right. So you have to reduce your expected return, and which is where post-tax return of debt and equity will again come back to the same level they were before, and therefore asset allocation will again shift from equity to debt. So prices are something which keep on making things balance in the markets.
Very interesting. Great, Manish. Thanks a lot. This was really insightful for me, and I am definitely going to check out a lot of other fixed income products now. So thanks a lot. Thank you.
Thanks, Ankur. Thanks a lot.
Alright folks, that's it for today. Thank you for watching. And if you like this, do check out our newsletter and our community. The link is in the pinned comments.